Right now, there's a very good chance your money is getting quietly robbed, and the thief is the bank you trust most. Here's what's happening. The cash sitting in your big bank savings account is probably earning about 1/100%. That's not a typo. Park $10,000 there for a whole year, and the bank hands you back roughly a single dollar. $1 for lending out your money all year long. Meanwhile, a high-yield savings account, an HYSA, pays you 40 to 50 times more. Same cash, same safety, same instant access. The only thing that changes is who keeps the interest, you or the bank. And this is the part that should make you a little angry. It's not a reward for taking on more risk. It's not locked away where you can't touch it. It's not some complicated product with fine print designed to trip you up. It's the exact same boring, government-insured savings, just held at a bank that isn't quietly pocketing your interest and calling it a service. This is the easiest money upgrade you will ever make. It takes one afternoon, costs you nothing, and most people never flip the switch, simply because no one told them to. So today, I'm telling you. Let's walk through exactly why this works, why it's just as safe, and how to fix it before the end of the day. Let's start with the number that started it all, the 0.01% trap. Picture $10,000 sitting in savings for 1 year. At a typical big bank paying that 0.01%, your interest for the entire year is about $1. You could find more than that in your couch cushions. That's what the bank thinks your loyalty is worth. Now move that exact same $10,000 into an HYSA, paying around 4.5%. Suddenly, that same year earns you roughly $450. Same money, same year. You did nothing different. You just stopped letting the bank keep what was yours. Let that sink in. We're talking about a difference of roughly 450 times. Not 450 times riskier, not 450 times more complicated. 450 times more money for the same deposit, sitting just as safely. The big banks are betting that the gap sounds too good to be true, so you'll never bother to check. They're betting on your inertia, and every month you leave that cash where it is, you're handing them an interest-free loan and getting pennies in return. By now your guard is probably up. If it pays that much more, there has to be a catch. It must be riskier, right? No. And this is the most important thing I'll say in this whole video. A high-yield savings account is just as safe as your big bank because it carries the exact same protection, FDIC insurance. Here's how it works. FDIC insurance is a government guarantee that covers your deposits up to $250,000 per depositor per bank. If the bank itself were to fail, your insured money is protected, full stop. And that shield covers the lean online HYSA exactly the same way it covers the giant bank on the corner. So why can these accounts pay so much more? It's not magic, and it's not risk. It's overhead. Most HYSAs are online banks. No marble lobbies, no thousands of branches, no armies of tellers to pay for. They run lean, and they pass those savings on to you as a higher yield. So before you open one, you do one simple check. Confirm the bank is FDIC insured. Almost all the well-known ones are. Once you've confirmed that, you're looking at the same safety, just without the big bank skimming your interest to pay for its real estate. Now let's talk about the real villain in this story. And it isn't the bank, it's inflation. Inflation just means that over time, the same dollar buys a little less. Prices creep up, groceries, gas, rent, by roughly 3% a year on average. It's gradual enough that you barely notice it day to day, but it never stops. So a dollar today quietly becomes worth less than a dollar a year from now, whether you do anything about it or not. Here's why that matters for your savings. If your cash is earning 0.01% while prices rise around 3%, you're not standing still. You're going backwards. Your account balance might look the same, but what it can actually buy shrinks every single year. That's the quiet theft most people never see. The number on the screen stays flat, while its real power leaks away. An HYSA doesn't make you rich, and it's not designed to. But earning around 4 or 5% roughly keeps pace with that 3% inflation. Instead of watching your purchasing power slowly melt away, you're holding the line. Your cash stays roughly as powerful next year as it is today. You're treading water instead of sinking. And when it comes to your safety net, Treading water is exactly the goal. So the choice isn't small interest versus more interest. It's slowly losing ground versus keeping your ground. Idle cash at 0.01% is a slow, silent leak, and HYSA patches it. So, if an HYSA is so great, should you just dump all your money in it? No. And this is where most people get the role of cash wrong. Cash is a tool, not an investment. And like any tool, it's perfect for some jobs and wrong for others. The trick is matching the right money to the right bucket. Two kinds of money belong in your HYSA. First, your emergency fund. That 3 to 6 months of expenses you keep for job loss, medical surprises, the curveballs of life. It needs to be totally safe and instantly available, and an HYSA is its ideal home. Second, short-term goals. Money you'll need within the next 2 or 3 years. A car, a wedding, a house down payment. You can't risk that in the stock market, because a bad year could hit right when you need it. But your long-term money, anything you won't touch for 5 years or more, does not belong in cash. That's what investing is for, and we covered exactly how in the Start Investing video. Over decades, even a great HYSA can't compete with the long-run growth of the market. So picture two homes. Safety and soon money go to the HYSA. Long-term growth money gets invested. Use cash for what cash is good at, and let your long-term money actually grow. All right, you're convinced. The last question is the one that stops most people. Isn't switching a huge hassle? It isn't. You can do the whole thing in an afternoon, and your money never gets trapped. Step 1. Open the account online. Pick a reputable FDIC-insured HYSA and apply right from your phone or laptop. It's a few minutes of basic info. Name, address, the usual. No branch visit, no appointment, no paperwork in triplicate. Step 2. Link your existing checking account. You'll connect the bank you already use, usually by logging in securely or confirming a couple of tiny test deposits. This is just building a bridge between the two accounts so money can move freely. Step 3. Transfer your savings over. Move your emergency fund and short-term cash into the new account, and you're done. From that moment, it's earning the higher yield while you sleep. And here's the key reassurance. The money stays completely liquid. This is not a lockup. You can transfer it back to checking whenever you want. It just takes a day or two to land. So you're not giving up access. You're just earning 40+ times more while your safety net sits there, ready the instant you need it. So let's bring it home. Stop letting your cash rot at 0.01% in a big bank that's quietly keeping your interest. A high-yield savings account is the same safety. Fully FDIC insured to $250,000 at roughly 40 times the yield. Remember the 4 things. 1. The gap is enormous, about $1 a year versus hundreds on the same 10,000. 2. It's just as safe because it carries the very same government insurance. It's leaner, not riskier. 3. Parking cash at near zero quietly loses to inflation, and an HYSA roughly keeps pace. And 4. It's the perfect home for your emergency fund and short-term goals, while your long-term money belongs invested. The switch takes one afternoon, costs nothing, and your money stays totally liquid. This is the rare upgrade with no real downside. So go flip the switch. If this saved you from quietly losing money you didn't even know you were losing, hit subscribe, because that's exactly what this channel is for. The money stuff nobody ever taught you, explained plainly. Next, CDs versus HYSA versus bonds. Where should your cash actually sit? I'll see you there.